Welcome back to Building Blocks. It's Tuesday and we have another unplanned episode. The U.S. Securities and Exchange Commission, or the SEC, has filed its second complaint of the week against a cryptocurrency trading platform. We're going to explore the complaints against both platforms. We'll also be explaining what securities are and why certain crypto assets are considered securities. Let's get started. Firstly, what are securities? In simple terms, securities are financial contracts that hold some type of monetary value. They can represent an ownership position in a corporation, a creditor relationship with a governmental body or corporation, or rights to ownership as represented by an option. The SEC uses the Howey test to determine whether a transaction represents an investment contract, and thus a security. The Howey test is a legal test used in the United States to determine whether a particular transaction qualifies as an investment contract and, therefore, falls under the definition of a security. The test derives its name from a landmark U.S. Supreme Court case, SEC versus W.J. Howey Company, decided in 1946. The Howey test consists of three elements that must be met for an investment to be considered a security. Investment of money. There must be an investment of money, including the provision of goods, services, or other forms of consideration. Common enterprise. The investment must be in a common enterprise, meaning that investors pool their money or assets with the expectation of receiving profits solely from the efforts of others. In other words, the investors rely on the efforts of a third party, typically the promoter or issuer, to generate returns. Expectation of profits. Investors must have an expectation of profits, primarily resulting from the efforts of others. This element is often met when investors anticipate a return on their investment due to the entrepreneurial or managerial efforts of the issuer or third party. If a transaction satisfies all three elements of the Howey test, it is considered an investment contract and falls within the definition of a security. Consequently, it becomes subject to various securities regulations, including registration requirements and anti-fraud provisions under U.S. securities laws. The Howey test has been instrumental in determining whether certain investments, such as certain types of investment contracts, cryptocurrencies, and initial coin offerings, ICOs, are classified as securities. Here are some implications of crypto assets being classified as securities. Regulatory oversight. If crypto assets are classified as securities, they will fall under the regulatory oversight of securities commissions. This means that the issuers of these assets will have to comply with securities laws, including registration requirements, disclosure obligations, and anti-fraud provisions. Investor protection. Securities laws are designed to protect investors by ensuring that they have access to material information about the investment and the issuer. The intent of classifying something as a security is to protect investors. Market integrity. Securities laws also aim to maintain fair and efficient markets and reduce systemic risk. If crypto assets are classified as securities, these goals will extend to the crypto asset market. Legal and compliance costs. Compliance with securities laws can be costly and complex. If crypto assets are classified as securities, issuers may face increased legal and compliance costs. Potential for increased institutional participation. If crypto assets are classified as securities, this could potentially lead to increased participation from institutional investors, as these investors are often more comfortable investing in regulated assets. Potential impact on innovation. Some argue that applying traditional securities laws to crypto assets could stifle innovation in the space. They argue that these laws were not designed with crypto assets in mind and may not be well suited to regulating these novel assets. Now, let's talk about Coinbase. The SEC has outlined that Coinbase has been offering and selling crypto assets that are considered securities under federal laws. These include SOL, ADA, MATIC, FIL, SAND, AXS, CHZ, Flow, ICP, NEAR, VGX, Dash, and Nexo. Despite being aware of the Howey test and its implications for determining whether a crypto asset is a security, Coinbase has continued to offer these assets for trading. This prioritization of profits over investor interests and legal compliance has put Coinbase under the SEC's scrutiny. Moving on to Binance. The SEC alleges that Binance and BAM Trading have unlawfully offered and sold crypto asset securities, including Binance's own crypto assets called BNB, and BUSD. Furthermore, Binance and BAM Trading have been accused of making misrepresentations to investors about controls they claim to have implemented on the Binance US platform. Other crypto assets identified as securities on Binance include AMP, REP, UST, and TRX. Both Coinbase and Binance are now under the spotlight for their practices. As the crypto world continues to evolve, it's crucial for investors and users to understand the implications of securities laws on their crypto assets. Things are moving quickly, but we'll try to keep you updated. Don't forget to like and subscribe.